This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us.
Yes, good. Yes, thank you for your time, of course, Hall. I'm making an imposition on yours, so thank you very much. And hope you're doing well. I got your name through Mireille.
That's right. That's right. We used to work together at National Instruments, and she said you're interested in talking with me. So I said, sure, I'd be glad to talk to anybody that you recommend, and looking forward to catching up with you.
Yeah, no, again, thank you very much. Really, really nice to be able to tap into your brain for a few minutes on the Friday afternoon. Yeah, so Mireille, she no longer lives in Austin. She lives in the Caribbean. I'm sure you're aware of that.
Yeah.
We are fellow Dutchmen, or Dutch people, I guess. So that's how our link got established. I myself have been in Austin for much less than the two of you, I think. I've been here since 2017. And I come from the world of, I'm originally trained as an architect. I come mainly from the consulting world, that is, of what used to be called customer experience before everything went online and became UX, UI, and everything became digital. I'm still one of these people that, at least once upon a time, tried to marry both the digital and the analog worlds in terms of experiences. And that's kind of where the line of work that I come from.
Oh, that's great. That's great. That's great. So what are you working on now?
Yeah, so that's something I'd like to discuss with you. About a year ago, a little over a year ago, I ran into an old classmate of mine from college days. We both went to a small liberal arts college in California. It's called Occidental College. Irrelevant for the story, but we reconnected and we found out that we both had an interest in first we had taken note, let me put it that way, that a lot of our contemporaries were kind of at this apex in their careers and their lives where, they had success of sorts, usually, at least most of the people that we spoke to. And then there was also this kind of nagging thing like, midlife's coming and I'm is this what I'm doing both in life and in professionally? Is that what I want to continue doing? Or, everyone sort of keeps hearing about increased longevity and sort of some people find out that they still have 3 or 4 more decades to go, and everyone starts scratching their heads like, okay, so what does that mean? What do I want to keep doing what I've been doing for the rest of my life? Or is there potentially a change in order of some sort? And that might be guided by, things like mortality, things coming to an end in other ways, careers, job layoffs, what have you. Still just people going like, okay, I've been doing this for 30 years now. I'm up for something new. So we spoke to a lot of those type of folks, and it led us to starting a company. It's up, and it's called More, and it was originally conceived as a community for these folks to come together to meet up and actually through interactions and thinking things through with others to come to new ideas for their lives or their careers. The career portion of that has actually really taken off. That's sort of the most tangible piece of the offering, where it's kind of like this book, Never Search Alone. I don't know if you've heard of this. It's basically based on sort of, if you're going to look for something new, make sure you have a cohort of people that can support you, that you can talk to and exchange ideas with, that sort of idea. We've done that too, and that's actually been quite successful, if you will, to date. The other bits of the offering, principally things like trips and retreats, where people get together, whether that be on a yoga retreat in Costa Rica or around the corner in Austin, or my business partner lives in Marin County in California, shall we say in Napa or something, for a long weekend. That has been a little bit slower. It's also lower margin, but it's definitely a very tangible part of the offering that we've had. And then finding the right balance, right, between online and offline, what really engages people. That's just been a journey of sorts. And, we're learning all kinds of valuable lessons there. My question to you, or the point I'd like to raise with you, Hall, and just tapping into your experience. I know you come from a slightly different perspective on things, and at least professionally, I'm supposing. I do know that, or at least Mireille told me that you are very good in sort of at least pointing people in the right direction when it comes to things like financing, attracting capital, that sort of thing.
Sure.
Now, we had kind of a grand vision, as does everybody, I suppose, who starts a business, of let's make sure we start this business as a C Corp, that we want to attract capital of sorts. we're actually finding out, we found that out rather quickly, that probably things like capital providers like, private equity or VCs, this is not the type of play that they're necessarily interested in for multiple reasons. We're probably going to have to attract capital with other types of parties, and whether those be, whether it be seed capital or even just, someone who's got deep pockets and really believes in this sort of thing would be interested to just sort of jump in on this. I guess what I'd like to ask you is, what would be your take on, running into something like this from a capital provision standpoint, if you will, and where would you suggest that we look?
So I always start with the exit and work back. I figure out how does the investor get paid back, and then I go from there. So if you had to tell me how we're going to pay people back, are we going to sell the business to somebody else and pay them at the end of it? Or are we going to never sell the business, but they can get a piece of the revenue? That would be a source of funding. If we, or we could say we really don't have enough to share the revenue with other people, then we start talking about getting money from the customer, prepayment or discounts or whatever, but they had to pay up front to help get it up and running. So what's the exit here? How would someone get paid back?
It's interesting. Originally, especially my business partner who comes from the financial world, he's like, "Oh, we're going to get VCs in here and they're going to get loads of money in, and we'll see how much of our shares we'll give to them." I have never really approached it from that standpoint. That said, we do have one thing in common, which is neither one of us is in it to become a millionaire. We do this because we want to help these people, sometimes too much so, I would say, almost unhelpfully so. But there's definitely the idea of, look, we just want to make a nice living off of this. And other than that, our aspirations are actually to serve, if you will. Now, what that means in terms of answering your question is probably to either get a stake or some sort of share of the revenue.
Okay. So that's when, if you're going to share revenue with people, then it's a type of debt, and you go out and you look for investors who want to put money in, and they want to get a piece of the revenue going forward. Restaurants are like this, retail are like this. I mean, we're just not going to sell that restaurant to Google for 10x anytime soon. When it comes to end of life, it just ceases to operate. But at the same time, it's not that hard to stand up and run, because it's not a mystery how restaurants operate. And for your deal, I'm not sure there's a lot of mystery there either. If you're selling a service or product for a fee, that's pretty straightforward. The thing you can often get into is that you can get into having, providing free services, but then you're using the result of that to get another customer to actually pay for it. And this is where we get into use of data. For example, I can go run a free service and provide a free app that has information, but I'm selling the data to other people who want to sell to those people, and they'll pay me money for the data. So that can be interesting. I can offer a free service, but I have this financing tool that helps them pay for the service for premium services or whatever, and I get a piece of the financing that goes into it. So there's second and third order revenue streams you can get into, but assuming we don't use those, we just go straight with it. We're going to go out and sell our service to people. And I need to know a bit more about the service, but one of the things we use is what we call anchor clients. I want to sell a standard service, maybe $100 per product to my customers, but I want to stand it up first. And the way I do that is I find somebody that wants a unique or custom version of what I'm doing, and they'll pay me, $5,000 if I build it for them in a custom, unique way. So I take $5,000 for them to build that unique service. But as I build it, I'm setting it up so that I'm going to be able to create my product. I'm going to get it manufactured. I'm going to get a software SaaS stood up with all the right software. So we look for 3 anchor clients, each paying a triple the standard rate to have a custom version. But we're using the money to go build it. And then at the end, we have a standard product that is sold for a standard price that everyone else can buy. Don't know if that applies here or not.
Well, in a way, I think I get what you mean, and thank you for suggesting it. We are definitely thinking about, okay, what's the balance here between, shall we say, consumers and corporate clients? And yes, there may be sort of a horizon 1, 2, 3 play where first you would start with direct to consumer, to whom it seems to appeal to some degree, although we are testing, okay, are people really willing to pay for what we have in mind between subscription and sort of a pay-as-you-go service? But then when you migrate to the corporate end, that's actually where we see something like you're mentioning potentially happening, where or larger corporate actually says, look, why don't you actually start, as you say, building a product for us that we can apply to a portion of our employees, for instance, the 50-plus-year-olds who have trouble motivating or motivating themselves to come through the door on Monday morning. What can we do for those people? That's where it starts to get interesting, at least in our limited point of view, I think.
Yeah. So a corporate client can pay a very nice price, but they want something very specific to themselves.
Right.
They weren't going to buy a standard product anyway. Okay. So we're going to take a contract out and we're going to take the project and break it down into 4 steps. The first step, you need to pay me 25% up front and I'll start working on it. When I get 25% through, you pay me for another 25% and I'll get halfway there, and so forth and so on. So you're hitting milestones, they're seeing it develop, they have confidence that they're getting there, they didn't put too much money at risk. But as you develop it, you accomplish the task, and now you've got the product stood up, and you can then turn that into a standard product more easily. I sometimes find it takes 2 or 3 clients to get all of the pieces you need. I used to work for a company where we would have partners that built systems out of our tools, and they would go get three anchor clients. And at the end, they would have a complete system, because sometimes there was some uniqueness that we couldn't reuse, and we had to fill in a standard piece later with other things. And the beauty of that is you get a customer that is telling you exactly what they want. They're testing what you're giving them, so they'll tell you where it works or not, and then there'll be a great reference afterwards. So when you go to market, you've got a successful group of clients that said this is a good thing as well. You also learn why can't you just go on the market and buy that? Well, it doesn't exist, or what's out there is not working, and so now you know your competitive advantage. So all of these things come out of that process, which is great because you don't have to go search out and try to figure out what's going on. They're just there telling you what they want. You do need to write out a statement of work and an architecture and all those things, which is good practice. But still, it's in some ways, it's a lot easier to figure out when you do it that way. I was surprised at how many SaaS platforms actually started that way. They were a digital marketing agency. The customer came to them with a problem. They couldn't find a solution on the market, so they built one, and then other people are asking for the same thing. So that model works a lot.
Right. Yes. I guess one little complication in that story, so far so good, I think. What's a good way to bootstrap it versus, when do you actually start thinking about getting money in? We by ourselves are struggling, for instance, to take on employees and sort of, people who could work for and with us, bar, giving out equity, which is also sweat equity is seen differently these days than it used to be. So I guess other than friends and family, what would be a way to, I guess, for sort of answering the question as I speak it out, perhaps, is would that building an app, something like building an app, would that be a way of actually willing to put all our savings into it?
Well, it helps to have a little bit of money from your side to go in. To start with absolutely zero, you can do that, but you'll spend a lot of time just trying to do very basic things like standing up a website, which really shouldn't be where your energy goes. It should be on your intellectual property, not basic stuff that you can pay for. So that's one thing. The other is sometimes you can take a consultation angle to this. I once coached people who wanted to go into the HR systems business and they didn't have any money. So I said, become an HR systems consultant and go around and install HR systems for companies, because you know all the packages, you know all the language, you know how it uses and so forth. And they tell you, okay, we're going to use this package. You then go get that package and install it for them and train them on how to use it and so forth. And after you do 2 or 3 of those, you become pretty good at that. And the value of that is you now learn everything about the industry, what's available, how the users are using it, what challenges, where the package succeeds, where it fails. And you just provide consulting services, fee for hire, to go and do whatever they need. Sometimes these things take a lot of manual effort to stand up. Sometimes they want to train 50 people on it, and they'll outsource it to you to go do the training. So you build some training material and you go do it. So I'd find some consultation type work in and around the space that you want to get in. Don't find consultation work in a space you have no idea, no interest in. It's not creating any value. But I find if you approach it as a consultant, while that's not scalable, that's a great way to get basic information and and then of course you build a network of people that are in that space, and you know what the channels are and the partners. And so it really lays a lot of groundwork for building a scalable business later.
Yeah. I like that suggestion. It's basically pulling forward what we had imagined would come a bit later, but I can see why that makes sense. Also, if anything, from a just generating some income point of view. Okay. I've got one last question. Perhaps that's the one most on my mind at the moment in our collective minds. We are two, so we're both 50% shareholders in a C corp. And as it happens, last month, my partner, he's the CEO for official purposes, not that it matters that much, but he had a lot of health problems. He first went to the hospital with what turned out to be about a pancreatitis. 2 weeks later, went back to the hospital with a heart attack. And of course, on the personal front, that's been, just first making sure that he's okay and all the rest of it. He actually suffered a widowmaker, one of those heart attacks where, 5% chance of survival, like a big one. As it happened, this was his second one, the second one in 8 years' time. And what I didn't know, he also had problems with his pancreas before. All to say, Hall, and this is where I'd like maybe give this like a little bit more, so say, personal advice. This partner of mine, he came through fine. He's still there and he's alive and breathing. However, he is going to have to go on a rather intense trajectory of cardiac recovery, doing all kinds of exercises and what have you, seeing all kinds of specialists and blah, blah, blah. His mind is off the business. His mind is on him, of course, survival, what to do from here, very angry at himself, right? Having launched something he really believes in with me, but now finding himself sort of unable to put in all the sweat and the work and the effort. On my end too, it's kind of like he's kind of taken off. He's on his own planet, if you will. I don't blame him for it, but that's effectively what's happened. And I find myself sort of thinking, gosh, what do we do here? Yeah, where should I begin? He's talking to other people who are making all kinds of suggestions to him, like, well, if you can't do it, I'll jump in there and this and that. But that leaves me as the other sort of shareholder and the other stakeholder in this thing, kind of like, all right, I know I can't just continue the business on my own. That would be asking way too much. Any ideas?
Typically, you if they're not able to complete the task, you buy them out and say, okay, I'll buy your 50% of the shares, but we'll give you a piece of future revenue for the shares that you have, and you have to agree upon what that's worth. And when we get to a place we can start paying out after a couple of years, we'll turn it on and you'll get money back for then. Yeah. Equity is illiquid at this point. Like, you could go out and try to find someone that will buy him out. They'll put money into the business or into his pocket to take out his half of the shares if he wants to, but you have to find someone that will come in and be a part of this. And typically what you do in these cases is you vest shares up front. When we start the business, we don't just get half the shares each. By the way, 50-50 is really not a great number to start with. I know.
We were pointing that out.
50 is better. But what you do is you say, okay, we're going to vest the shares. We get it over a 3-month period, or 3-year period, I should say. Actually, first year is no vesting, and then the next 3 years are every month you vest your shares. And so you get some. So if you could go back and retroactively vest your shares and say, if we started a year ago, well, then you haven't really earned any shares yet. And if you're stepping out and not able to do it, well, then that 50% of the cap table can go to someone to take your place. And this is very common with investors. They'll come and unvest founders' shares and say, well, this project's supposed to take 3 years. We're going to invest your shares back, and we'll let you invest it over every month over a 3-year window. And if you leave a year into it, well, then there's 2 years worth of equity left to go pay someone who hasn't left yet, and you can come in and pick up and do the work. So that's a common way of doing it if it wants to do it. How long have you guys been doing this?
Well, I mean, we haven't actually traded for that long, but we have, and you're right, just to conclude, you should go back to the vesting schedule. I have to look it up, but we did give ourselves pretty much a year of sweat equity. So that's what we're at.
Could just be a straight up negotiation. What do you think your year is worth? I think it's worth $100K. Okay, I'll give you $100K of revenue. We'll start that 2 years from now with what revenue. And revenue shares typically are around 2-3% of top line revenue. And you just start getting paid out year 2% of top line revenue until they get their $100K back. So you could do a rev share agreement, and the more revenue we have, the faster this gets paid back. The less revenue, the less it gets paid back. So that incentivizes them to help you get to revenue faster as well. with whatever way or whatever he can do with it. But that's one way to do it, is just get him a cash out plan and start doing revenue shares. Actually, you start revenue shares from day one. If we sell a 10K contract, you get 2% of that. But don't be talking about 20 or 30%. That you can't run a business doing that. Revenue-based funding is 2, 3, 4% at most, never above 5, because you do have to run a business. But that would be one way. And so he gets a path out of it, but it's not going to be a super fast path at this point, unless you wanted to pull money out of your pocket just to pay him off and go forward from there. But that's a pretty rare case too.
What might because revenue for us, we're very low revenue. So it's hard to look at revenue guidance, I would think. Are there any other options?
So the two choices I give them is, one, let's do a rev share agreement, get 2% of any revenue until you get 100K back. The big revenue is not going to hit for 2 or 3 years. So you're going to get small checks, or maybe they're quarterly, just to keep the admin down. Or I tell you what, I'll give you 50K out of my own pocket and we'll just call it even that way. So if you want to get paid right away, we'll just do 50% discount and you can walk away with a 50K check and you just sign over all your shares to me. That kind of agreement. So people that want money fast, they usually give up something for it. People that are patient, you get your full earnings or whatever that is. Again, you have to negotiate these things out at some level. And, you can use discounted cash flows. You can use other tools to figure out how much money you might make off of it. But same time, at the end, it's going to have to come out of revenue. It's hard to raise funding to give to someone that's exiting the business. The investor's putting money in, want to know the money's going to go grow the business, not pay off a previous shareholder in some way.
Okay. Yeah, I have a feeling it's going to go towards that cash payment. But all right. Yeah, no, that structures my thinking.
Okay.
I think that's it, Hall. I think that's it.
Well, cool. Yeah, well, good catching up with you, and let me know what we can do to help. It sounds like you got a good plan there, and so looking forward to next steps and see how that goes.
Well, yes and no. We'll have to see how this story unfolds. This latter story. That's really sort of putting a little bit of a damper on everything. Excuse me, particularly in the short term. There's just not much we can do. We're in a bit of a holding pattern at the moment.
Right.
But you've given me some things to think about here to move forward at least.
Okay.
So,
well, great.
Wonderful.
Well, good luck with it, and have a good weekend.
What, if I may ask, just real quick, what keeps you busy these days? What are you getting involved with mostly? Just for me to know.
We still help startups raise funding. So we live every day the funding process, and we work with companies raising from angel, VC, family offices. Equity funding is mostly what we do. I have done revenue-based funding and some other tools, but mostly it's equity is where it mostly lives. And we're just out there growing our business and having a lot of fun with entrepreneurs raising funding.
Yeah. Well, what kind of, is it still tech heavy with your background, or what?
It's about half technology, of course, AI and everything. And then the other half is now life science. Life science has come up strong. The cost of starting a life science business has dropped dramatically, and everybody is choosing a novel target to try and take to market because the exits can be spectacular there.
Yeah. I'll bet. Wow. Yeah, that's a whole different animal. All right. Well, listen, I very much appreciate your perspective. I'm mindful that it's almost weekend too for a long weekend. So let you go ahead and get closer to that. But really appreciate getting to know you, and hopefully you'll find it okay if I once in a while tap back into your brain.
Yeah, sure.
Perhaps,
Someone back for
more
a
we
chance
can do going forward.
Catch up.
I'd appreciate that.
All right.
Thank you, Hall.
Have a good one.
Take care. You too. Bye-bye.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.